Good day, everyone. Welcome to today's session on transfer pricing in specific industries. I will be guiding you through the complexities of transfer pricing across various sectors. So, in this module 10, we will be looking at transfer pricing in specific industry. So, transfer pricing involves setting prices for transactions between related parties within a multinational enterprise. It is a critical tax and compliance issue as it directly impacts how profits are allocated across different tax jurisdictions. Each industry presents unique challenges when applying transfer pricing rules influenced by the nature of the operation, the types of assets involved, and specific regulatory requirements. So, today we will explore transfer pricing in six distinct sectors: oil and gas, which is going to be the first one, financial services, manufacturing, digital economy, telecoms, and pharmaceutical industry. So these are the sectors we'll be looking at for the purpose of this module. We will delve into the key considerations for each industry and examine real-world case studies to illustrate successful strategies and outcomes. So, like I said earlier, we'll be looking at transfer pricing in the oil and gas sector, transfer pricing in the financial services sector, transfer pricing in the manufacturing sector, transfer pricing in the digital economy, transfer pricing in the telecom sector, transfer pricing in the pharmaceutical industry, and we will look at some case studies and then conclusion. So please let us get started. Okay, so let's begin with the oil and gas sector. This industry is characterized by complex, high value transactions that often span multiple jurisdictions. It is a capital intensive and highly regulated industry, necessitating meticulous attention to transfer pricing for activities such as exploration, extraction, refining, and distribution. So it is it's a very regulated sector. So transactions in this sector frequently involve significant intangible assets, including exploration rights and proprietary technologies. Therefore, aligning transfer pricing policies with international standard is very critical. So now let's look at the key considerations in the oil and gas sector. We'll start with the intangible assets. Valuation of exploration licenses. So the valuation of exploration licenses, production sharing agreement, and proprietary technology is critical. These assets are often location specific, and their valuation must accurately reflect the sector's inherent risk and reward. So it is important that you take this into consideration, the intangible assets like the valuation of licenses, exploration rights, and proprietary technology. Very important. The next is cost sharing agreement. You can see that we're looking at specific, industry specific now. We are trying to take some issues, the core issues that happen to each of these industry as aside the general principles that we have been looking at from transfer pricing from module 1. So now let's look at the next one, cost sharing agreements. So a cost sharing agreement is a contractual agreement. A cost sharing agreement is a contractual agreement. Sorry for that. A cost sharing agreement is a contractual arrangement where related entities within a multinational group agree to share the cost and risk of developing or acquiring certain assets such as intellectual property or research and development in exchange for future benefits. So let me take that again. A cost sharing agreement is a contractual arrangement where related entities within a multinational group agree to share the cost and risk of developing or acquiring certain assets, such as intellectual property or research and development, in exchange for future benefits. Now, in the oil and gas industry, cost sharing arrangements often apply to exploration and development activities. So these agreements allocate costs based on the expected share of future profits or resource extraction. Now, the challenge in ensuring that these allocations meet arm's length standard where each entity's share reflects what an independent party would agree under similar circumstances. So it must be done on arm's length principle. Now, commodity pricing. The pricing of the pricing of the pricing of crude oil and refined products must mirror market rates. So the pricing of crude oil and refined product must mirror market rates. Transfer pricing policies should utilize market benchmarks such as Platts or Argus pricing to ensure intra-group transactions are priced at arm's length. Yes, you can also use an Orbit. Those are some of the platform. Now, let us examine a case study here. Let us examine a case study. Now, ABC Oil Limited, a multinational oil and gas company, employs a cost-sharing agreement or arrangement between its Nigerian subsidiary and a UK-based entity for exploration costs. So during an audit, the Nigerian tax authorities scrutinized the arrangement to ensure the cost allocation aligns with the arm's length principle. So ABC Oil Limited successfully justified its transfer pricing policies by providing comprehensive documentation and benchmarking studies, resulting in a favorable audit outcome. Now, the whole basis of this is that the general principle of transfer pricing still apply, but what we are saying is that there are some key things that you need to take into consideration if you are in the oil and gas sector, and we've explained those three, which is the intangible assets, the cost sharing agreement, and the commodity pricing. And now we've also looked at a case study with respect to the oil and gas sector. So now let's move to transfer pricing in the financial service sector. Now, moving on to the financial service sector, which encompasses banking, insurance, and investment services, transfer pricing in this sector primarily deals with the pricing of intercompany loans, financial derivatives, and the provision of management or advisory services. So we need to take note of these services that I've mentioned: intercompany loans, financial derivatives, and the provision of management or advisory services. Now, given the stringent local and international regulations, compliance with tax and financial rules is paramount. Very, very important. Now, let's look at the key consideration again, one after the other. Now, intercompany loans. Now, interest rates or loans between related parties must reflect market conditions. Benchmarking intercompany interest rates against comparable market loans is essential to comply with the arm's length principle. Very, very important. Another thing that we need to look at is the service fees. So pricing of management and advisory services provided by one related entity to another must align with the value of the services rendered. This often necessitates detailed analysis and comparables from third-party transactions. Now, with respect to regulatory compliance, financial services companies must adhere to both local regulations and international financial regulations, both local tax regulation and international financial regulations, such as the OECD-based erosion and profit shifting rules. So they must comply. Now, just like, for example, the financial sector, let me say banks, for example, that is regulated by the Central Bank of Nigeria, it is important that you must also comply with such rule when considering your arm's length principle. You need to consider all regulatory um, compliance issues must be noted. So now, from the financial sector, we're trying to be more specific with the issues that might arise in specific industry and with this particular one. So when you are doing anything with respect to in any of the financial service sector, the things you need to be more conversant with or to look more in details, which might be very risky, and which the relevant tax authority might want to scrutinize properly in detail, are intercompany loans, service fee, and regulatory compliance. Is very, very important. So now let's look at a case study. So let's consider the case of XYZ Bank. XYZ Bank, a multinational bank with operation in Nigeria and the United States of America. So XYZ Bank provides intercompany loans between its subsidiaries. The Nigerian subsidiary charges interest based on market rate. Now, supported by benchmarking studies, so these interest rates that are based on market rate, which is supported by benchmarking studies, that is the supporting document now that we've done a benchmarking study to get the market rate. So during an audit, the Federal Inland Revenue Service or the Nigerian Tax Authority verified the interest rate against comparable uncontrolled transactions. Now, confirming that XYZ Bank's compliance with transfer pricing regulation. So, having done their audit and they were able to verify the interest rate against comparable uncontrolled transaction, they confirmed that XYZ Bank, comply with transfer pricing regulation. So you can see the importance of that. Now, let's move to the manufacturing sector. Now, we examine the manufacturing sector. This sector is diverse, involving the production and distribution of goods that may pass through several stages, such as raw material extraction, processing, distribution, before even reaching the end consumer. There might even be some level of packaging, even before that distribution, packaging or even repackaging. Now, transfer pricing in this sector must effectively address the allocation of costs and profits among entities involved at various points in the supply chain. Now, the key consideration with respect to manufacturing, you can see cost allocation. Cost allocation. Manufacturing, distribution, and marketing costs must be allocated appropriately among related entities to ensure fair profit distribution. Now, the profit split. Now, this is another key consideration. So, profit generated from the manufacturing process are typically split between different entities based on the value added contributions to the production train. So, the profits that are generated from the manufacturing process are typically split between different entities based on their value added contribution to the production train, Very, very important. And let's look at the transfer pricing method here. Though the transfer pricing method, such as the cost plus method and the transactional net method, are frequently applied to ensure pricing consistency with the arm's length principle. So in this particular industry, most of the method that are applied is the cost plus method and the transactional net margin method. Looking at a case study now, let's explore the DEF Manufacturing Limited, a Nigerian company that produces electronic components for its German parent company. Now, DEF Manufacturing Limited employs the cost plus method to determine the transfer price by adding a markup to production cost. So, when audited by the Nigerian Tax Authority, DEF Manufacturing Limited provide extensive documentation and benchmarking studies, resulting in a successful audit outcome. So it is very, very important that you always have your benchmarking studies to defend your documentation. Yes, now let's turn our attention to the digital economy, which includes businesses involved in e-commerce, software development, and other digital services. Transfer pricing in this sector involves valuing intangible assets, allocating profit from digital transactions, and navigating the evolving regulatory landscape that addresses digital activities. Now, the key consideration here in the digital economy includes intangible assets. The intangible assets, such as the software, patent, trademark, must be meticulously valued. These assets are often these assets often hold significant value in digital businesses, necessitating robust analysis to meet arm's length requirements. So another key consideration here when doing transfer pricing documentation for digital economy is the pricing of intercompany digital services such as software licenses or cloud services must reflect market rates. The global nature of digital transactions complicates profit allocation due to operations across multiple jurisdictions. Now, the third one is the nexus rules. Companies must ensure compliance with local tax law regarding digital presence and economic substance, especially in jurisdictions that impose digital taxes. For example, in Nigeria, where we have the significant economic presence, there are conditions that need to be met with respect to significant economic presence. And once you meet those conditions and you meet that threshold, you must comply with the local tax law regarding digital presence. Now, let's look at a case study with respect to the digital economy. Now, let's consider Digital Limited, for example, a Nigerian software company that licenses its software to related entities worldwide using a royalty-based model. Now, during an audit, GHI Digital Limited provide documentation demonstrating that its royalty rates reflect market conditions. The Nigerian Tax Authority accept the transfer pricing policy, confirming its compliance. So if they have done the necessary benchmarking and the intercompany services or the licensing agreement between the use of his software and his other related entities worldwide, using the royalty-based model, if it is at arm's length, then they will not have any issue with the Federal Inland Revenue Service. So far, it is confirmed that it is at arm's length and it can be supported with benchmarking studies to indicate that yes, it is actually at the market rate. So we move to transfer pricing in this telecom sector. We examine the telecom sector, which involves providing mobile, internet, and satellite communication services. So transfer pricing in this sector also addresses the pricing of intercompany services, equipment transfers, and intellectual property licensing. So the key consideration here include service pricing. So communication and technical services provided between related entities must be priced to reflect arm's length conditions. The equipment transfer or the transfer of telecom equipment between related parties should be priced based on market rate, necessitating comparison with similar transaction in uncontrolled settings. Now, licensing fees. Licensing and usage fees for telecom infrastructure, such as spectrum licenses, must be appropriately priced based on the value derived from these assets. Now, let us look at the JKL Telecoms Limited, a multinational telecom company that transfers network equipment to its Nigeria subsidiary. JKL Limited utilizes the comparable uncontrolled price method to determine the transfer price by comparing it with market prices for similar equipment. And upon audit by Federal Inland Revenue Service, the transaction pricing is confirmed to reflect market rates, ensuring compliance. So we've been using case studies to ensure that, look, there are some telecom, there are some specific industry that you need to look at some certain specific peculiarities that is attached to that industry, and those are the things that we put under key consideration here. For telecom, we are looking at service pricing, equipment transfer, all those masts, what else again, what other equipment, all those equipment that they use, in the course of providing services, and even licensing fees. Licensing fees, the use of rights and all those things, and infrastructure and all those technology is very, very important. So um, now finally, let us explore the pharmaceutical industry. This industry encompasses research, development, manufacturing, and distribution of pharmaceutical products. Now, transfer pricing in this sector focuses on valuing intangibles such as patents and allocating profit from product sales across related entities. Now, there are some specific considerations that we need to look at with respect to pharmaceutical industry, which include research and development cost. This research and development cost must be allocated between entities based on their contribution to developing new drugs and products. Now, the intangible assets, patent, trademark, and proprietary technology are significant assets in the pharmaceutical industry and must be appropriately valued for transfer pricing purposes. Now, aside the research and development cost, aside the intangible asset, we also have profit allocation, which is also important for pharmaceutical industry. So profit from the pharmaceutical products should be allocated based on the value added by research and development, manufacturing, and distribution entities. So let us look at a case study now. Let's consider MNO Pharma Limited, a Nigerian pharmaceutical company that conducts research and development activities and holds patents for new drugs. So MNO Pharma Limited licenses these patents to its manufacturing subsidiary in India. Utilizing the profit split method, MNO Pharma Limited allocates profits based on the value added by research and development and manufacturing industries, or by allocates profit based on the value added by research and development and manufacturing activities. So during an audit, the Federal Inland Revenue Service reviewed the arrangement and certified with the documentation and methodology, confirmed compliance with transfer pricing regulation. We've made this session in a way that if your documentation are properly done, your documentation, your what do you call it, benchmarking, and all the necessary things, you keep adequate record of master file, local file, CBC, and all that. Everything that encompasses transfer pricing documentation. These are the things that we look at in previous modules with respect to transfer pricing documentation. You can go back and look at that, look at the requirements in the transfer pricing documentation. If all these things are properly done and your documentation are adequately kept, you won't have any issue with any tax authority at all in any jurisdiction. So in conclusion, transfer pricing is highly industry specific. Transfer pricing is highly industry specific because requiring companies to adopt tailored approaches to address the unique challenges in their specific sectors. So I'll take that again. Transfer pricing is highly industry specific, requiring companies to adopt tailored approaches to address the unique challenges with their sectors. So compliance with transfer pricing regulations involves selecting appropriate methods, conducting robust benchmarking studies, and maintaining detailed documentation. Now, all the case studies we reviewed today illustrates the practical application of transfer pricing principles, offering valuable insight into successful strategies for managing transfer pricing risk and ensuring compliance. Thank you very much for your attention.